So today we want to check a new topic here, IFRS 2. So right there. From the back. Share-based payment transactions. Share-based payment transactions. That's our topic. Now, an entity, we are not writing, an entity can enter into agreement with third parties, including employees, provide services for a given number of years or period. Then in compensation, they can give you some equity instruments such as shares. They can also promise to give you cash, but cash will depend on the equity shares of the company. Or third parties can provide goods. They can provide goods to the entity, and in return, they are given the equity instrument. So where an entity has promised to give out equity instruments to third parties based on fulfillment of certain conditions, then you have to recognize, because accounting, immediately you anticipate to incur an expense, immediately you have to recognize that expense as a provision in the books. So our question will be, you have entered into a contract with employees that maybe you will give them shares after 10 years. Giving out shares to a company, is an expense because there is always the dilution effect on the earnings per share. So that expense which you anticipate to incur in future, how should you recognize it in the books during that period until the date when they will be exercised? So that is what we want to check. So before that, let's write something small. You say, so we are writing, a share-based payment is a transaction. A share-based payment is a transaction in which an entity receives goods or services. In which an entity receives goods or services by issuing its equity instruments, or by incurring liabilities, for amounts based, on the prices of the entity's shares, entities with apostrophe, amounts based on the prices of the entity's shares, or other equity instruments, of the entity, full stop. So just that's what we have said. They receive goods or services. In return, they issue equity instruments, or they give cash, but the cash they are giving will depend on the company's share prices. Types down there, types of share-based payment transactions. types of share-based. We can leave those many stories there, transaction. Types of share-based. So we have we have three of them. We have equity settled, share-based, equity settled, share-based, cash settled, share-based. Then we have what we call choice, stroke hybrid. Choice stroke hybrid, share-based. So we have three forms of share-based payment transactions. We have equity settled, cash settled, and we have choice, which sometimes is called hybrid. Let's start with equity settled share-based. Let's start with equity settled share-based. Let's start with equity settled share-based. So under equity settled share-based, you say, is a form of share-based payment, is a form of share-based payment is a form of share-based payment transaction in which an entity receives goods or services. An entity receives goods or services in return for its equity instruments. In return for its equity instruments. Full stop. So if they are compensating through equity, then that is called equity settled share-based. 2, cash settled share-based. Cash settled share-based. Cash settled share-based. Then you say is a form of share-based payment. Is a form of share-based payment. It's a form of share-based payment in which an entity receives goods. In which an entity receives goods stroke services. Receives goods stroke services in return for cash. In return for cash. Full stop, continuation. However, the cash is based on the entities with apostrophe. The cash is based on the entities, share prices. Based on the entities' share prices. Full stop. So what happens, check here, we agree. For example, you entered into a contract with Safaricom back in the year, let's say the year 2004. So in 2004, you said that I'll be giving you services, but you will pay me. The first time I'll be paid in the year 2022. Then we come into an agreement that you will pay me cash, but the cash you are paying me will depend on the company's share prices. So we will just discuss how many share options. Then you say maybe 10,000 shares. So on that date, because ungelipo at 204 Safaricom shares were trading at around 4 shillings number 2, thereabouts. You know, right now 30 something, 35 there. Yes. So if you could have been paid by this time, you see you could have gotten 40. But right now, the agreed number of shares remains, but now you'll be paid based on the current share prices. So strictly, you'll be paid in cash, but the cash will depend on the company's share prices. So what you agree, how many share options? Then you will not receive shares, you'll be given cash, but the cash will depend on the current market prices. But for equity, purely, You enter into those positions, provide the goods or services, then upon the expiry of the period you agree, you get the equity instrument, mostly in form of shares. You get the shares of the company. So for cash, you agree on the number of shares, but you don't receive shares. You will get cash, but the cash will be based on the company's share what? Prices. Then choice. Is it at the beginning of the contract or cash? This one. Yes. No, amount is not agreed. What you agree is the number of shares. You are entitled to 10,000 shares. And you will be paid in future, like in 2022. So 2022, we just go to the stock market, we check how much is the price. Then we multiply by that price. So if the price will go down, it is now up to you. So it will depend. So fine. Then hybrid, like Mumias, okay. Hybrid or choice, you say, is a share-based payment transaction. Is a share-based payment transaction in which the counterparty here is the third party, the counterparty, which the counterparty is given a choice. It's given a choice of either, being settled, through equity or in cash. Full stop. So you are given that privilege. You are given the privilege of either being settled in cash or through equity. You are given that privilege. So for accounting, given those questions, there will be no question on choice. Once you know equity and cash, then you know this one. This one is just a contract which specifies. You know, sometimes they are strict. That this time around, we are only operating on equity, share-based, or on cash, or you are given an option to select whichever you feel. So choice is either equity or cash. It's just a provision you are being given to select the one in which you want to be paid through. Subtopic, accounting for share-based payments. Accounting for share-based payments. Accounting for share-based payments. Then you say, share-based payments are accounted for. Share-based payments are accounted for, depending with their nature of classification. Accounted for depending with their nature of classification. Full stop. So how you account for them depends on whether it is equity or cash. So let's start with Roman 1, equity. Equity settled share-based. Equity settled share-based. Equity settled share-based. Then you say IFRS 2 requires that an entity should recognize. An entity should recognize a liability, and an expense, in relation to the equity instruments, that have been granted. Equity instruments that have been granted to third parties. Full stop. So what it means, when a company has entered into such contracts, is an expense on behalf of the organization, giving out shares as well as liability. So as the time goes by, the entity should recognize an expense in relation to that. And you know, when you accumulate expenses, accumulated expenses results to what? A liability at the end of the day. Terminologies, so there are some terms we have to familiarize ourselves with when we are accounting for equity. So terminologies, terminology number one, vest. Vest is V-E-S-T. So they'll tell you the equity were to vest on 31st December. So vest means to be entitled to, just like that. To be entitled to. To be entitled. So they'll tell you, if they tell you in the question that the shares were to vest on 31st December, then that 31st December is when that counterparty was entitled to take the equity instruments. Next, vesting conditions. Vesting conditions. Vesting conditions. Vesting conditions. Then you say, these are conditions that must be satisfied. Are conditions that must be satisfied by the counterparties. That must be satisfied by the counterparties. By the counterparties in order to become entitled. In order to become entitled. In order to become entitled to the entities. Entities with apostrophe. To the entities, equity instruments. Equity instruments or cash. Or cash. Full stop. Down there, say there are two types of vesting conditions. There are two types of vesting conditions. Two types of vesting conditions. But there I fear those things. Situation whereby you have been with this employer for the last 5 years. Then all of a sudden they start telling you that we want you to become a shareholder. Do you just accept easily? Or provided now you are going to become shareholder director so that you deal with the shares accordingly. There are things you have to, when you hear like this issue, most of the private sectors, the employer has been arrogant throughout. There are people who are arrogant by nature and can be changed. And in your office, where's the reports? Hata kuna salamu. Then it reaches a point, mkifika job unasikia asubuhi, let us have a word of prayer. Going concern is in danger. Is in danger. Very. You need to be very careful. Then finance manager anaenda, wewe ndio unaambiwa you take over. We will see what to do on your salary. Kuna kitu kama hiyo, sana hiyo kitu. So vesting conditions are the conditions that whoever is being given this equity, they are required to satisfy in order to receive those equity instruments. So we normally have two conditions. One, performance condition. So I want you, when you scan, ukiangalia swali, you can know this is performance condition or this is this other one. So performance condition, you say, are conditions which requires the counterparty. Are conditions which requires the counterparty. Conditions which requires the counterparty to achieve certain level of performance. To achieve certain level of performance. Certain level of performance in order to receive equity instruments. In order to receive in order to receive equity instruments of the entity. In order to receive equity instruments of the entity. E.g., for example, an employee may be required to achieve certain profitability level, full stop. Yeah, so that is a performance condition. We are told if you increase the profitability, because for the last 3 years, we have been at 40%. If the profitability can go up to 70, then we promise we are going to give you some shares. Next, service. There is service conditions. Service conditions. Then you say, are conditions which requires the counterparties, which requires the counterparties to provide services to the entity, for a given period of time. In order to receive the entity's equity instruments, stroke cash. Equity instruments stroke cash. Full stop. Next, grant date. Grant date. Then you say, so service condition, the employee was required to work for the next 10 years. So provided you are there for the 10 years, they will not care about your performance. You will just receive the equity instruments without anything. Grant date, it is the date when the entity, entered in the contractual agreement. The entity entered into the contractual agreement with the counterparty. Contractual agreement with the counterparty. So when they will tell us the question grant date was 1st January, blah, blah, then that is the date when they agreed on that, on the share-based payment transaction. Next, exercise price. Exercise price is the price that the counterparty will be expected to pay. Is the price that the counterparty will be expected to pay for the equity instruments. Be expected to pay for the equity instruments. Full stop. Sometimes it is not that free to pay for the equity instruments. Full stop. You know, being given the privilege of having shares does not mean that always you'll be given for free. So it's just a privilege of being given. So if they tell you the exercise price is this, then that is the amount that other party is supposed to pay. Fair value. So fair value as in a general definition, which I'm not going there. Let me define it in relation to this. Is the market value of the instrument. The market value of the instrument. Instruments in bracket options. The market value of instruments in bracket options. Last, intrinsic value. Intrinsic value. Intrinsic value, you say, is the difference between the fair value and the exercise price. The difference between the fair value the difference between the fair value and the exercise price. Full stop. Full stop. That is enough. So, once we do 1, 2, 3 questions, they are quite similar. They know what is happening. So get out our past papers. And for the records, share-based is standing a very good chance of being examined. Very. Based on the trend. Now, if you are saying here, because when I post this thing online, customer is a watcher. But kama wana shughuli na nini, kuna some people who are malicious. If they don't have problem with you, share-based should be examined this. So, kitu muhimu ni kuelewa how do we work it so that when you get it in whichever form, you can be able to approach. Allow me to start with 2021. 2021. September, there was September 2021. September 2021. Check which question was this. September 2021. Question 3B. September 2021. Question 3B. September 2021. Let's read. It seems everyone has the question. So it says, another limited. Each another again, or in 2B, eh? Or I think your dinner, your Peponi Limited decided to grant its 500 employees how many share options? 200 share options each from 1st July 2021 on condition that the employees will still be in employment as at 30th June 2025. Which condition is that? Service. The company has provided the following details regarding the share option scheme. Because how it is valued is quite unique. Year ended 2022 all the way to 2025. Number of employees expected to leave employment, you can see for each year. Fair value of each option, as you guys can see. The fair value of the options was £40 on 1st July 2021. The exercise price of the option was £15, and the par value of the company shares was £10. The average market price of the shares over the 4-year period is expected to be £50. Required extracts from the financial statements of Peponi Limited for each of the years ended 30th June 2022, 3, 4, 5 to reflect the above transaction, 8 months. So in the financial statement, for P&L, you need to recognize employee costs is an expense on the company giving out the shares. Then in the balance sheet, you need to recognize a liability. So the question will be, how do you calculate that expense and how do you determine that liability? So someone to send the question for, there are some people crying, they don't have the question. So someone can take a photo and send. So let's have their solution. Can someone send that photo very fast so that that person cannot struggle? Oh, no, because we are different. What are you assigning? No, at least you are in which class, so that there's a group or early morning, evening, or which one, so that someone can know where to send. Evening, Chelsea too. How many megapixels? So working, let's have a working here. And once you know this working, you are safe. So just write for me here. Right there, here. We started in which year? 2021, No, 2021, 2022 financial years. No. So 2022, 2022. No, let's work yearly because of the space. Then you can say here workings. Then I will get accumulated expenses here. Accumulated expense. Accumulated expense is a liability. So this is a liability. When you accumulate expense, it becomes a liability. Then expense for the period. Expense for the period will go to profit/loss account. How's that? That is how we normally arrange our workings. How we normally arrange our workings for share-based. All of them, actually, all share-based. That is how the workings is always arranged. So from the workings, you can answer any question, whether journals, whether anything. So for 2022, the expense, what you have to appreciate first, giving out shares is an expense to the entity, is an obligation. And when you accumulate expense, finally it becomes what? A liability. So you need to check the value of the options which you have given out. So 2022, how many employees were there, which were the employees who were given the options? How many employees? There were 500. Eh? However, in year one, there was an estimation that how many are leaving? 40. So you will say, fine, there were 500, but there was an estimation that 40 may leave. So, and each of them was given how many options? Each of them was given 200 options. Then each option at shillings how much? 2022. How much is the value of the options? Shillings 40. Shillings 40. Then listen to this. The employees who are expected to leave, that's not the actual number. They just said expected. The expected is based on probability. So we always work with probability. So this is just year one out of how many years? 1, 2, 3, 4. There are 4 years. So that is year one out of 4 years. You work with that probability. That. So the accumulated expense for that year one is how much? $920 or thereabouts. Get 920. So this is 920. This being year one, the expense for that year is also the accumulated. So that is 920, 920. Let's go to year two. Let's go to year two. So in year two, 2023, expected to remain in year one for how many? 460. So expected to remain there was 460. Expected to leave 2023. 30. Can you complete year 2/4? But don't post. Just complete, then you calculate for me the figure. Online you can post for me the figure there, but don't capture that figure because what wanaweza kuwa na different answers. So just complete what is remaining there. Watu wengine hata nikiwaza kitu rahisi wanaona hii si rahisi. Kwa nini naachwa? Ama niendelee kidogo. Times 200. Let's proceed. See. I just want the figure for that year too. What you get in that bracket, the entire bracket, after multiplying with 2/4. You say your figure without fear.
1,505.
10.
1505.
1505, eh? Or thereabout. 1505. Even online people are posting 1505. I did not carry my calculator. I did. Kuna kitu hapo. There is something. Nataka mkose ndio tusikose tena. So 1505 for 60 minus 30 by 200. Then this is here. So 0.5. 200. The answer should be 1720.
Yes.
Hey. Yes. The correct answer is 1720. Kuna kitu kadogo hapo. Na hiyo kitu la kwanga rais la examiner anatumianga tu hiyo kurudisha watu fellowship. You know what happens? Unakosea, ulize kwenye unakosea. Hapo kwa shillings ndio unakosea. I know you people are picking 35, eh? No. For equity, I'll tell you what is happening in cash. For equity, you stick to the price which was there on the grant date throughout the vesting period, regardless of the period. Though there is an exemption in a small exemption, which I'll tell you later. But I even take it practically. On Monday indication, we to a boardroom. Directors wamekuita boardroom. Na ukakuja wakakwambia the reason as to why we have called you here, we have seen your work and we wish that you be part of the shareholders. So we want you to work for the next 3 years, then we give you shares in this company. I want us to flow. Which will be your question? The first question. Like they want to give you shares. If you are comfortable, but what will be your first question? And where am I supposed to? Where should you pay? No. That is not the first question. We want to give you shares. Which will be your first question? Before you make a price question too. The question is, how many shares? Can I pay? You are paying for how many shares? So the first question, how many shares? Then we have given you 200. Then question 2, what is the value of each share? Then they tell you the value of each share will be a shillings. How much? 40. Then now, as time goes by, we don't know if the prices imeanza to change because of stock market. Unaitanga bulls and what? The bears. It keeps on now fluctuating 35, 30, 30. So if you allow that you will be paid depending, watangoja ile siku imefika 20. Na wewe mulisikizana at 40. So the rule is for equity, I'll tell you what happens with cash. For equity, you stick to the price which was there on the date when you entered into that contract. throughout the vesting what? Period. Even if the vesting period is 10 years. Sawa? Yeah, so wale walikuwa napata 1720. Mulisikia wapi? Kwa nini mmepata? That's the question now. Hey. Sawa. One bad. Yes.
Meaning that contract to specify
the price.
We are having these things that.
Yes.
Yes. If you ask in court.
Yes.
So we agree the price of change. So irrespective of any changes of price.
Whether ikienda juu sana, you will not change. Ikienda chini, you will not change. You stay there. So that is how equity behaves. There's a small exemption, but I'll bring the exemption later. You can't apply here. So the accumulated is 1720. But now that the same 460 were the same people who are there in the 500, in here too, you just take the increase. So you take this minus this to get the increase, which will go to here. How much? Where would you like 1720 across? The 460 were part of the 5. So what goes to P&L is the increase. So you take this minus this, you get how much? 800. Okay. All right, let's go to 2024. Now it will be okay. 2024 expected to remain there for 30. Expected to leave. Expected to leave 25. 200 shillings 40. This is here 3/4. How much do you get? What do you get? 24/30. So just give me the increase. Minus 1720. 710. Finally, 2025 expected to remain here 405. Expected to leave 25. 240. 4/4. 30/40. Increase minus 24/30. 610. Wenye walikuwa napata hiyo 1720 na naona mwingine anasema but the question is very clear. The question is very, very clear. So but this is not the question. This is just a working. Check the question. The question is on the extract from the financial statements of the fund for each of those years there. So extract means you show us the P&L extract and also you show us statement of financial position. So write for me down there. The Pony Limited. The Pony Limited extract of the statement of profit stock loss. They wanted for all those 4 years. All those 4 years. So this is 2022, 2023, 2024, 2025. So shillings are there. Tax. So extract, you just give us the income and expenses which you are capable of seeing. There is no income here. You can only see an expense. So expenses. So expenses here, we have staff costs. So staff costs, that one there, those expenses you have. So this is 920 for each year, but it's a provision you are making because they will exercise at the end of the year 2025. So for now, you just make a provision. Accountants are aware that when you anticipate to incur, you make an earlier provision, 710, 610. It's always very interesting. Then let's do the extract of the statement of financial position. If you are done, write the same. Peponi Limited, extract of the statement of financial position. So 2022, 23, 24, 5. All right, so equity, right here, equity. Then you say options to equity. Some people will recognize liability, there's no problem. But if they want to convert them into shares or equity, these are the amounts which is outstanding as per now. What can be converted in each financial period? So here we have 920. You can write in full, I don't have space. 1720, 2430, and that is 30, 40. You can have them in full. I'm lacking a space there. That is it. They were awarding us how many marks? 8. So the 8 marks is 1, 2, 3, 4, 5, 6, 7, 8. Next, let's go to the next question. Let's meet in November 2021. No, this is 21. 2020. Let's go to 2020 November. November 2020, November 2020, 2020. Question 3A. Question 3A, November 2020. Mutashika. How it is done. Alafu wataleta. Right? They will bring. November 2020, question 3A. Kindly check for the question. Let's read the question. John is asking, the exercise price is not necessary here. It would have been necessary if we were required to prepare journals. And now, because there are some questions with where we are required to prepare journals, we'll see how it applies. But you just take our mission. The people will remain after year 4. You multiply with the exercise price, you debit cash book, then you credit equity. But I think there's a question of that nature. Let's read this. Madini Limited issued share options to its directors on 1st of January 2019. The options have a vesting period of how many years? 10 years, and at a fair value of shillings 20 as at the date of issue. In order to be eligible to exercise the share options, the directors are required to remain in the employment of Madini over the entire vesting period. And you guys about 10 years to pay shares. Actuaries have estimated that 20% of the directors who have received the share options will leave the employment of Madini Limited over the vesting period. The financial year end of Madini Limited is 31st December. Required, advise the management of Madini Limited on how to account for the share options in the financial statement for the year ended 31st December 2019, 6 months. When did they enter into this contract? January 2019. So they just want to advise for one year. So even our computation is just for 1 year. You can just extend that to year 2. How do you answer such kind of question? I've been saying it so many times. Advise the management. That from what I can see, some people have left. 20% have gone. So, to advise when there is calculations, first of all, tell us what the standard requires. Standard nataka nini? From the working we have done here, what is the standard? What does the standard require? Nataka tuweke tu answer skeleton. From the workings, the standard nataka nini kuhusu hiyo share options?
The entity should
don't be serious. Just on face value. The entity should recognize a liability and an expense for during the vesting period. That is what the standard requires. So we can put it in writing. Usikwe serious sana. You say, actually, they say that for you to answer most of the theory questions, like Akina LM and audit, you should always translate these things in your mother tongue. Then now you put them in English. Senior. That is how it goes. So IFRS 2, but I know here there are people who do not know mother tongue. So if your mother tongue is Kiswahili, put them there, then you translate them in English. IFRS 2 requires that an entity should expense the fair value, of the share options. Should expense the fair value of the share options and recognize a liability. Over the vesting period. Recognize a liability over the vesting period. Full stop. But because in the question they never mentioned anywhere IFRS 2, and in exam you can be asking yourself, was this thing? You remember there was 2, but you don't know whether it was it IPSAS 2, IS 2, IFRS 2. So we said there is no quoting if you are not sure. So how will you play around that? Yes, according to accounting standards, an entity should recognize an expense and a liability in relation to share-based payment over the vesting period. So can you do the calculation? Then you show us how we are supposed to account for it. So Let's have our normal working there. Year. Oh, it's just 1 year, so it's not going to give us a lot of stress. So year. Then you can tell us year workings. Then accumulated expense, which is a liability. Then the increase will be the expense for that period, which will go to profits or loss account. So 2019, but it's for how many years? 10. But the question is up to 2019. Let's just go up to 2020 on what if they required 2 years. So they never mentioned the number of directors. There's something they said. Let's revisit there. They said that issued share options to its directors on this. The options are vesting period of 10 years and are a fair value of shillings 20 million as at the date of issue. In order to be eligible and to exercise the share options, the directors are required to remain in employment over the entire period. Actually, it's estimated that 20% of the directors who have received the share options will do what? They will leave that employment. So what the examiner has done, he has taken the number of directors, value the entire amount. The fair value of shillings 20 million, they have already valued. So what you can do, you can say it is, yes, it is 20 million, but expected to remain. We normally work with expected to remain. So expected to remain will be 80%. That is the expected to remain. We work with the expected to remain because 20 is expected to live. But this one here is year 1 out of how many years? 10. Because 80% is expected to remain throughout the 10 years period. So you cannot subject it only in year 1. That is why you have to work with that probability. So this is 20 times 80% year 1 over 10. That comes to 1.6. If we were required to continue, maybe 2019 was like year 4, year 2, then in 2020, because what is required is this one here, it will be this way, it will be 20 million. Expected to remain is what percentage? 80. But now what you change is the probability. So this one will remain the same, expected to remain. It will be 80 throughout the 10-year period. What will keep on changing is the probability. So that one will be 80 of that, 2 over 10. 3.2. Yeah. So this is 3.2. The increase will be 1.6. So you can just continue up to year 10 if you don't want. You cannot waste time which we don't have. Then down there, I can give them even journals if I want. For that here, I can say journal entries. Journal entries. Journal is all about debit and credit. Debit and credit. You can give them the journals for that here. So employee cost, which is an expense. So employee cost is 1.6. Options to equity. Options to equity, also 1.6. So if they want to exercise, well, that is the expense, and these are the number of shares they can get in that year. Let's do P&L extract. The extract of profit account for 2019. So 2019 P&L. P&L. So employee costs, the 1.6. Then you can give them the balance sheet. You mnanifanyia balance sheet. The same thing. The statement of financial position, just have it in bracket extract. Extract. Have it as extract. Then instead of expense, just say equity. The way we did the other one, equity. Then you say options to equity. Also how much? 1.6. Year 2, 3.2. So work for me the statement of financial position. Extract equity. Then you say options to equity 1.6. 1.6. That's what's challenging. 20 December November 2018. November 2018. November 2018, which question? This is also asking which question. I'm also asking which question. November 2018, which question? 3B. So November 2018, 3B. Yo que la van a 2018 3B. Yeah. 2019. Okay. 2018. Yeah. 1C. 1C. Question 1C. Question 1C. So. Repata. Haya. Read the question. Question again. Karatasi yangu November 2018 inakuanga imefichwa. Bado inakuwa ngumu hata sijui inakuwa. This which page? 52 ama 50? Yangu ni 52. So kama iko 52 itakuwa uko 58. So 1C. Yes. Let's read. It's always a nice question there. On 1st of January 2015, G Limited granted each of its 200 employees. How many share options? 500. These share options were to vest if the employees still worked for the entity as at 31st December 2017, and if the share prices on that date exceeds shillings 45. On the grant date, the fair value of each option was 15. The share prices on 31st December 2015 was shillings 27, and it was considered unlikely that the share prices would rise above 45 by 31st December 2017. 20 employees left the company during the year 2015, and a further 20 were expected to leave in each of the 2 years, 2016 and 2017. During 2016 and 2017, 15 employees and 25 employees left the company respectively. Required extracts from the financial statements of G Limited for each of the years 2015, 16, and 17 to record the above transaction. Si serious, ni kizungu tu iko mingi. So what you do, so mnajua ile format, tunaanza na hiyo format, then God will just bring those things as we know. Utakuja tu, utaona tu ikikuja. For example, ukiandika year, unaona we share day 1 2015. Si at least neighbor kwa mjane naona unaandika. Then working. So now we know what is happening. You write the liability. You don't have to keep on saying accumulated expense. Back in our head, we use accumulated. Then expense for the period. That's. So now, the only thing I know you will ask me is the 45. Go to some about 45. They granted each of the 200 employees 500 share options. These share options were to vest. If the employees still work for the entity in 2017, and if the share prices on that date exceeds 45. Vest, we said the meaning of vest is to do what? To be entitled to. So they will be entitled to if it will exceed what price? 45. Otherwise, you will continue being there. So 45 will not be that very relevant for valuation. Valuation just take to the share prices on the grant date, no matter the change. So in 2015, how many employees were granted the share options? 200. 200 were granted the share options. Then there are so many stories. Check paragraph 2. Check paragraph 2. Check paragraph 2. The share option. Here. No, 20. Eh? Yes, 20 employees left during 2015. So 20 left. Our meta kabisa na wameresign. And what is the projection? 20 have left. 20 left in year 2015. And a further 20 were expected to do what? To leave in each of the 2 years. So right now, the number of employees who have left are how many? 20. But already you can, from the estimation, you can see that how many are expected to leave in the next 2 years? 40. So when you anticipate, unatoa immediately. So 40, 2020 for the each year, 2020. So 20 have left, but there is expectation that 40 will leave in the near future. In accounting, when you anticipate, you have to adjust in the books. Then when that year comes, you work with the actual because you have made the provision. So 20 left, 40 expected to leave in the next 2 years. I know someone will ask, why do you bring this 40 and it relates to next year? Because already we have that anticipation that they will do what? They will leave. You make that provision immediately. Hata watu wanafanyanga hivyo for tax purposes. It's one way of tax planning. And how many options? allowable. 500. What was the price on the grant date? On the grant date, be careful.
15.
On the grant date, the fair value of options was 15. That is the one you apply. This is year 1 out of how many years? 3 years. On grant date, the price was 15. Those 27 and the rest are just the fluctuations in the stock market. How much is that? 350,000. So this is 350. 350. All right. Let's go to 2016. Expected, okay. In 2016, we had how many employees at the start? There were 200. The actual who left in 2015 were 20. Though they were anticipating 40 will leave. So let's check out of these 40, how many have left in 2016 and what is our next projection. So go to 2016. Where's 2016? During the year 2016 and 17, 15 employees and 25 employees left the company. So like in 2016, they were projecting how many will leave? 20. So it was 2020. So out of the 20 who are being projected, the actual number who have left are how many? 15. And now in 2017, there is no projection right now. So no, how they project, they have just given us the actual number. The actual you did with them in 2017. Unless if they said they still anticipate, then you make that provision. So 515, year 2/3. Then you get the increase. So that one comes to how much? Huh? 885. 825. 825. And this one? 475. 2017. 200, 20 left in year 1, 15 left in year 2. How many left in year 3? 25. 500, 15. Year 3/3. Bora ushajua hiyo mpangilio, ikikuja itakuja tu kitu kama hiyo. Labda wa change kidogo. Read the required. Okay, this one comes to 1050. Increase 225. What was required? Extract. Extract is mmezoea. So extract of P&L, you know what to do. 2022, 2015, 2016, 2017. Expenses. Employee options or employee costs, sorry. You take the increase, the 350, the 475, and the 225. Then you go to the balance sheet. Balance sheet, you can even work it for me. The equity. And in the equity, you could recognize this one here. So equity for balance sheet, so right, statement of financial position extract is just those options. Options to equity, which you can convert, then bring those figures. The way I know you people, those are small issues. Eh? Those are small issues. Ruth is asking, in the previous question, the number of employees kept on reducing, 500 for 60 like that. But this one, 200 has just been here. See that? See, tungesema tu hapa, instead of this, we will have. Yes, I just maintained 200, but for example, if you check here, I've reduced from here. So you can still do the same way we have done that other one if you wish to. There is no problem. 2017, May 2017, May 2017, question 2C. May 2017, question 2C. May 2017, question 2C. My paper is confused. No, it's that one. Got it. Are you there? All right. And I read May 2017, question 2C. Na mtapata tu kwa mtihani kitu kama hiyo. Sharp. Everyone, you 2017, that question 2. It is C or B? May 2017. What me, I'm in which 2017? Oh, me niko December. December is more or less, that one I can't do. It's more or less the same with the one we have done. But if we jump on December, I show you something. Then we proceed. But we will confirm the same with one which we have done. There's something I want to show you there. Just showing, then we go back. December 2017, question 2B. So I tell you how they play off our minds. H. Yeah, December 2017. Question 2B. Mayona, R limited. So what I want, the caution, but if you check it, is more or less similar with the one we did. So inakaa ile here tutakuja kufanya it is cash settled but the same. So what I wanted to say, unaona May there was share based. So students wanasema, mwalimu anasemanga it is either share based or employee what benefits. Then they concentrated on employee benefits. Then in December, naona waleta zote mbili. Part B is share based. Part C, si part C ndio hiyo mambo ya actuarial gains. So those two topics ni ngumu sana, the two of them to miss. Either all of them to appear or at least one. Right now we are expecting share based or both, but not none. None inakuwa ngumu sana. So this one nimeona ni cash settled, which will come there after this. So let's concentrate with May. May, masema the question 2C. May 2C. Journal entries. Yeah, I'm already there. Yes, I wanted something at least to do with journal. Question 2C on the journals. It says, and I read, on 1st of January 2015, C Limited issued 500 share options. Sasa sieli kwa kwanza. Hiyo part A, kama uko kwa class, make sure uko na notes. Those who are there at the start, did I teach you explain the accounting embedded derivatives? Did we do embedded derivatives somewhere? Yes, ziko kwa notes. Distinguish between fair value hedge and cash flow hedge. Did we cover something like that? Yes, they are in your notes. So financial instruments, just make sure unasoma hizo vitu. All those we have covered. So on 1st of January 2014, C Limited issued 500 share options to each of their 1,000 employees eligible for the employee share ownership scheme. The fair value of each option at the date of grant was 30. The options had a vesting period of how many years? 3 years. And any employee who resigned before 31st of December 2016 was not eligible to any share, but it's obvious. As at 1st January 2014, the management estimated that 5% of employees will exit during the year. On 1st January 2015, the estimated number of employees who had exited was revised to 8%. So, the estimated number of employees who will exit was revised to 8%. So that is in 2015. Actual information from the company's human resource department indicated that 24 employees exited during the 2014, 17 during 2015, and 6 during 2016. Required journal entries to record the transactions with regards to the share options for each of the years 2014, 15, and 16, 8 marks. Explain how your answer in C above will be different if the employees had the option to be paid the cash equivalent to the market price of the share. That is cash settled. So, nimewambia, no matter how it looks, anything to do with the share based, we anzia tu hapa. Ukimaliza hapa, you will even find you can do journals. The journals unaandika debit and credit, then you can bring some issues there. So let's do that working, then it will just come out clear. There is something there which I want us to check. They have given us the probability and also the actual information. So have there here. So we have here, we have the workings. Workings, then we have the liability. Then we have the expense. Yeah. So the year we have 2014. So I have there 2014. Have 2014. So 2014. In 2014, the only issue which is here, they estimated that what percentage will leave? 5% will leave. How many employees were there? 1,000. So the question which always comes up in relation to this question is this actual number. There is this actual number from HR of people who left. Did the HR give them for, did they provide each year, or they waited until the end of year 3 is when this information was provided? That is the question which comes up. Did they wait until the lapse of the 3 years, then they provided the actual information, or were they providing on annual basis? From what you can see. Where umesema they? Hey, you have said.
But I think it is because they normally come with the number of every year, meaning the information was available at the end of the year.
Sure.
Because look at progress exceeded during the year to December 2014.
Okay. And when no. Yes, there is something is asking. Why are they estimating if they have the actual figure? That one brings another accounting question. When do you make provision? At the earliest period or at the end? When do we make the earliest? Yes, exactly. And that is why they are reviewing the employees in January. Ukiangalia, when were they reviewing the percentages? In January, so that they can make what? Provision. So what will happen for 2014 and 2015, those 2 years, you will work with the estimation. Then the actual, the last year, you will work with the actual number who did what? Who left. So you will work with the estimates, the ones which were expected to do what? To leave. And also when you can estimate, estimate should always be above the actual. So 5% were expected to leave. What is 5% of the times the number of employees? So 5% of that? You know, 50. And the actual who left in 2014? 24. So the provision is better than, provision should always be above the actual. So we will, if you have the percentage and the actual, then you work with the percentage on the assumption that the actual are also included in the estimates. So we will have here 2014, we have 500 employees. expected, 1,000. Okay, thank you. So we have 1,000 employees expected to remain. We are working with expected to remain 90, 95 times the number of options. So now, Dominic, why do we less the number of employees by estimates and also actual? No, down at what I bullet here. So 95% of 1,000. How many options? 500. And each option was valued at 30 on the grant date. Year 1 out of 3 years. So when you have the estimate, where you are asking, why are they giving the estimate when the actual is there? Because estimate is normally provided at the earliest period. So that is made at the beginning of the reporting period. That one comes to 4750. 4750. Let's go to year 2. Year 2, 2015, they revised. They revised it to, the number who are expected to leave was revised to 8%. So expected to remain, we work with what percentage? 92. The price remains constant. So that one comes to how much? 920.
Yes. No, 9.2.
9,200. Increase. Increase of how much? 44.50. Yeah. In 2016 now the actual, they were 1,000. What is the actual who left in year 1? Year 1, 24 left. Year 2, 17 left. Year 3, 6 left. So those are the ones who are remaining. Students, what is the issue? What if the estimates were to be for the other years and not 2014? It will be there. At the 2014 Wanyamaza, you have to be told what is happening in regards to employees. Every year you must be told. They can't keep quiet. They can't. If there is no actual, then they must tell you the estimate. When you have the estimate, you work with the estimate and not actual, because we make provision first. Yes, this is graduated 3. So what do you get?
14,295.
1429.
14,295.
295 with an increase of 50, 95. So when you have estimate and the actual, we always work with the projection. Projection will work better because projection is made at the earliest, while the actual is known at the end of the period. So we cannot wait until. And the question was categorically on journal entries to record. So they don't want the extract. This time around, they want the journals. So write for me there, journal entries. Any moment you hear of the word journals, the examiner is asking you which account to debit and which one to credit. So have journal entries. Yes, please.
Now, general advice.
By general advice.
Yes.
Is that?
Whenever you are for the beginning, you work with 2021, this the last year is when you determine now the action.
Yes, because action cannot be known at the end. Na hii inakuwa provision. Provision should be made at the earliest period. So when you have the two, when you have the percentage and the actual, we normally work with that percentage because percentage is the provision.
So the beginning years you always work with that.
Yes, yes, yes.
Estimate, and then the final.
Unafanya variance huko mwisho. It is not an actual practice. Yes. Alright, so have this. Let me reduce the thousands. So we want to pass the journals for each of the 3-year period. For each of the 3-year period. For each of the 3-year period. So 2014, just debit employee costs with 4750. Then you credit options to equity. Options to equity, you also credit. This one you credit with 4750. These are special liability which can be converted into shares. 2015. In 2015, you also debit employee costs. Employee costs with 4450. Then options to equity, the same. You post the same amount so that you keep on accumulating here. So that total, itakuja this value. So 4450. In 2016, you will have 2 of them, 2 journals. One is to pass the normal employee cost, which is 5095. Options to equity. Options to equity, also 5095. Be careful. There's another one. Don't close. That's the last year. So they will pay. They will pay all the amount which is due to them. What is due to them is this one here, which you can also add. If you add the 3, this plus this plus this, they will exercise. So when they exercise, those who are eligible, you will debit the cash book, with how much? 14,295. Then you give them those shares. So credit the equity account. Credit equity with the same amount, 14,295. So you will give them shares equivalent to that amount, 14,295. Full stop. Then they were asking, explain how you will answer. Your answer in C, command 1 above would be different if the employees have the option to be paid the cash equivalent to market price of the shares vested 2 months. So you write down there, if employees were to be paid cash equivalent to the market price of the shares we are answering Roman 2. If the employees were to be paid cash equivalent to the market price of the shares, equivalent to the market price of the shares, then it should be accounted for. Then it should be accounted for. It should be accounted for as cash settled, share-based, as cash settled share-based. Full stop. So that one also brings us now, what we have been doing is equity. Now that one brings us to a subtopic, cash settled share-based. Ruth, someone will send, or I'm recording the class, so I don't know. Cash settled share-based, number 2. Cash settled share-based. So right there I'm saying, is a form of share-based payment in which the counterparty delivers goods stroke services. The counterparty delivers goods stroke services. In exchange for cash. Which is based on the entities with apostrophe, which is based on the entities' share prices. Full stop. Another thing, the only difference between equity settled and cash settled share-based, is that in a cash settled, the options are to be valued. Using the fair value, for each respective financial period, during the vesting period. Full stop. So that's the only difference. So what it means, actually it's done the same way. December 2017, that question which we are checking, December 2017, question 2B. December 2017, question 2B. Is that the same way? There is actually, even in the workings, everything is the same. The only difference is here. Check here. Difference is here. You know, cash, that we will pay you cash. The way I was telling you, Safaricom, we put our supply. But with Skizana, you started supplying them in 2004. Then you agreed that payment will be the year 2022. But it will be based on the value of the company's what? Share. So in 2004, you are told we will give you, it will be based on 1,000 what? Options. So come 2022, you just take those 1,000 options, then you check the stock market, what is the current market price, you multiply, then you are given a check. So, you know, for cash, due to inflation and all those other issues, we say that the price itabaki constant. So you come as Safaricom, 204, it was roughly 4 shillings. So kama ni 4, you cannot value them using that for throughout. So ukipewa for each respective financial period, that is what you're supposed to use. Go to that question. No, we are not doing it. I'm now to be a solution because they are the same. The only difference, instead of using the uniform, now, so what do we solve? I'm just giving you a solution here. Time up. Keep up, is there. December 2017, question 2B. December 20, page 60, which one? 60? 63. Yangu ni 63, ya mwingine? 78. Cheza between 78 and 63. I just want to read, then I'll put your solution up. There's no difference between the two. Except that. So it says on 1st of January 2014, R promised to pay its 200 employees a bonus in cash. So that one tells you it is cash settled. Come on, equity or equity, those options. So a bonus in cash, that will be based on how companies' share performed on the securities exchange. The bonus was to be paid on 31st of December 2016 as long as the market price of the company shares was 55 and above, and the employees were still working for the company. As at 1st January 2014, the market price of the shares was 50, and the par value of one share was shillings 10. The bonus was to be equivalent to how many shares? 100. So underline 100. 100 is very key there. So the following information for the 3 years, year 14 to 16, number of employees leaving, market price for each year. All the employees who are in employment by 2016 were paid the bonus. Show how the bonus will be accounted for and reported over the 3-year period. Mostly when you are told to show how, mostly make sure mupitisha journals somehow. So nothing is going to be serious. Just take the number of employees, those who are expected to live in year 1, then you multiply. So come ni equity, the value, you will have used which value? Angalia pole pole. Which value do you have used? Be careful. Which price, if it was equity? 50, yes. The one which was there on the grant that I can see people saying 50. But here, we are going to value them using the prices for each respective what? Yeah. So we'll use 55, 58, and 60. Have that solution as I'm sharing now, so that you can just see. Ama ufanye kwanza. Kuna watu wanangoja tu hiyo. You can do it fast. I'm under a lot of pressure. I am sharing the solution. So I'm sharing that solution. Utaelewa tu. There is nothing serious there from what we have been doing. Ni solution. The solution. So I'll share the solution to that. That is the end of it. So let's meet in our respective classes for group. I end it there because I have something to attend to. So we meet in our respective classes tomorrow for group accounting. Next week we are doing deferred tax. So yes, deferred tax. Those small topics now will remain with the deferred tax and impairment loss. Then now apart from group, the EPS and reconstruction. Then will you manage? But there's a day I want you here for at least 6 hours. Can you sit for 6 hours? Yes? You know, mtakuja na lunch. Yeah? Of course. So one of these fine days. I'm at 10. Yes. So thank you. I put up that solution. Kuna watu wanapaka. Maliza hiyo.